Welcome to the deep dive. Imagine money not just as coins or numbers on a screen, but more like a shared belief, a kind of social contract.
Right, a collective agreement on value.
But what happens when that contract, well, breaks? History shows it's often chaos, kings messing with coin values, bank runs, crazy speculation, stuff that could bring down whole countries.
It's a messy history.
And out of all that mess, two huge institutions kind of rose up, your national central banks and their global big brother, the IMF, the International Monetary Fund.
The architects and maybe guardians of the system we have now.
So today, we're really going deep into your sources. We want to trace their story, this long, winding path from, 17th century scandals right up to digital cash and climate change debates today, and try to get why their decisions impact your life so much.
It's fascinating because this history, it's not some neat plan someone drew up. It wasn't conceived in a flash of genius.
No grand design.
Not at all. It's more like this ongoing argument, really, between nations wanting control and needing to cooperate globally, between private companies wanting profit and the public needing stability. And, between the sort of cool technical ideas of economic stability and the messy reality of politics. Understanding that evolution helps you see not just what they do now, but why it actually matters to you.
Okay, let's get into it. Central banks today, we see them as these pillars of stability, right? Keeping prices steady, issuing money, being the lender of last resort.
The essential functions.
But these jobs, they weren't there from the start. It was more like learning through failure, starting with a big scandal, actually, back in 17th century Sweden.
That's right, the very first one.
So picture this, Sweden, mid-1600s, their money, these massive copper plates, some weighed almost 20 kilos.
Yeah, imagine trying to buy groceries with that. Impractical is an understatement.
Totally. So this guy, Johan Palmstruch, he sees how banking works in the Netherlands and gets permission to open Stockholm's Banco in 1656.
A private venture initially.
Right. And his big move in 1661 was issuing credit notes. Basically, Europe's first proper banknotes, backed by copper deposits at first, and people loved them, much easier than lugging copper plates.
Convenience is king, even then.
But here's the twist. The bank's success kind of doomed it. It was private, but deeply connected to the state. The king, powerful nobles, they all started taking out huge loans. Paid out not in heavy copper, but in these handy new banknotes. Pretty soon, the bank is printing way, way more notes than it has copper in the vaults.
So effectively, Europe's first go at unbacked fiat money, created out of thin air.
Exactly, and people got suspicious. A bank run started, and boom, September 1663, the bank collapses. Palmstruch gets charged, found guilty. Serious stuff.
Oh, so the lesson there, it's pretty stark, isn't it?
Seems like it.
It's about that unchecked power, the temptation to just create money. It's immense, whether it's a private bank like Palmstruch's or, King, if there's no check on that power.
Things go wrong. Fast.
Right. That Swedish disaster really hammered home the need for strong, independent governance and a clear focus on keeping money stable. That principle, it echoes down through every central bank created since.
So, from the wreckage of Stockholm's Banco, you get the birth of the modern central bank idea. The Swedish parliament, the Riksdag, steps in. In 1668, they set up Riksens Stender's Bank, later called Sveriges Riksbank.
But under parliamentary control this time.
Crucially, yes, under their control, creating a firewall against the king just dipping in whenever he wanted. And its main job, right from the start, was legally mandated. Maintain the domestic coinage at its right and fair value.
There it is. Price stability baked in from the beginning.
Okay, fast forward just a few decades. Across the North Sea in England, another major central bank pops up, but for totally different reasons.
Yeah, the context is key here.
England's bogged down in this expensive war with France, the 9 Years' War. King William III's government needs cash, badly, but nobody trusts them enough to lend it. Their credit is terrible.
A familiar story for governments needing money for wars.
So, in 1694, a plan emerges. The governor and company of the Bank of England is set up by Parliament. Its first job, lend the government £1.2 million for the war effort.
So created specifically to finance the state.
Exactly. And in return, the bank, a private company, remember, gets special perks. A monopoly on joint stock banking, for one. It's the government's banker, manages its debt. It quickly becomes the powerhouse of English finance.
And its role grew over time.
Definitely. Over the next century, its banknotes become widely used. And because it held the government's accounts and reserves for smaller banks, it naturally evolved into this lender of last resort during the financial panics that kept happening. It would step in with emergency cash to stop the whole system from crashing.
So if you compare Sweden and England,
Very different origins.
totally. And it highlights this fundamental tension that's like built into the DNA of central banking even today.
Yeah.
The Riksbank, Sweden's bank, was set up by lawmakers to stop the king from printing money recklessly, a check on state power. The Bank of England, created to help the state fund its ambitions, a tool of state power.
So they're pulled in two directions from the start.
Precisely. Caught between being this disciplined guardian of money's value and, well, being a helpful ATM for the government when it needs cash. That tension never really goes away.
So these institutions, born differently, they grow stronger. We get this first era of, globalization, financial globalization, under banks like the Bank of England, usually tied to the gold standard.
A period of relative stability for a while.
But then the 20th century arrives and everything just shatters. Unthinkable chaos.
Yeah, World War I was the first big blow. It repped the old gold standard, left behind this mess of war debts nobody could really pay.
And the attempts to rebuild it in the 20s.
Fragile. Didn't last. Then the Great Depression hits, and international cooperation just collapses completely.
Nations turn inward.
Exactly. Protectionism goes way up, high tariffs choking off trade, discriminatory trading blocs form. And maybe the worst part, competitive devaluations. Countries deliberately tanking their own currency value to try and grab a trade advantage.
Which just drags everyone down.
A total downward spiral. Destroys trust, deepens the global slump. It was a disaster.
So the big lesson from that whole interwar nightmare
Was that a global economy needs some kind of framework for cooperation on money. Without it, it's dangerously unstable, prone to collapse.
Right. The Depression wasn't just, markets crashing. It was a massive failure of countries working together.
Absolutely. Policymakers saw that closing borders, going it alone economically, it didn't protect you. It made the global disaster worse for everybody. And that realization, that stark failure, was the real driving force behind wanting a totally new system after World War II.
So even while the war is still raging, Allied leaders start thinking about what comes next. How to build a stable global economy for a lasting peace.
The vision starts early, with Roosevelt and Churchill in the Atlantic Charter in '41.
And two names really stand out in designing this new order. John Maynard Keynes, the famous British economist,
Towering figure.
and Harry Dexter White, a very influential guy at the U.S. Treasury.
Both agreed on the goal. Stable exchange rates, no more of that beggar thy neighbor stuff.
But their plans were really different, weren't they? Kind of reflecting who is now top dog globally.
Absolutely. Keynes, representing Britain, whose empire was fading, he wanted a truly global system. The sort of world central bank, the International Clearing Union, with its own currency, the bank core. His plan was more balanced, putting pressure on both countries with deficits and countries with surpluses to adjust.
Okay. And White?
White, for the rising U.S., proposed something more, U.S.-focused. A stabilization fund with less power, built around the U.S. dollar as the main currency convertible to gold. America and the dollar right at the center.
So the showdown happens at Bretton Woods, New Hampshire, July 1944. Delegates from 44 allied nations.
3 weeks of really intense talks.
And the final deal, a compromise but leaning heavily towards White's American plan.
Yes. And out of Bretton Woods come these two huge institutions we still live with, the World Bank and its twin, the IMF. The IMF officially kicks off in December '45, and its whole purpose was a direct answer to that interwar chaos. It was built to be the guardian of this new system of stable, predictable exchange rates.
Every part of its job description was meant to prevent a repeat of the 1930s.
Exactly. Promote cooperation, keep exchange rates stable, explicitly banning those competitive devaluations, and provide short-term loans so countries could defend their currency value without resorting to destructive policies. Basically, the world's economic umpire and an insurance policy against chaos.
But there was a catch from the start.
There was. Rejecting Keynes's more balanced banker idea in favor of White's dollar-centric model, well, it baked in what people later called the exorbitant privilege of the U.S. dollar. It wasn't a flaw that crept in later. It was there in the 1944 design, and it kind of sowed the seeds for the system eventually falling apart.
Okay, so for 20 plus years, Bretton Woods looks like a huge success. The golden age of capitalism, right? High growth, low inflation, global trade booming.
It seemed to work incredibly well on the surface. Central banks and the IMF had this symbiotic relationship, maintaining stability.
What were the mechanics? How did it work day to day?
Well, the national central banks did the groundwork. Their main job was keeping their currency pegged to the US dollar within a tight 1% band. So they'd buy or sell their currency and dollars in the markets to maintain that peg.
And the IMF?
The IMF was the supervisor, the backstop. It watched countries' economic policies and offered short-term loans if a country's reserves got low, helping them fight off speculators trying to break the peg.
And this predictability was great for business.
Hugely important. It fueled that massive post-war economic expansion. But beneath the surface, that core contradiction was brewing.
The Triffin dilemma you mentioned.
Exactly. Articulated by Robert Triffin in the 60s. The world needed more US dollars to grease the wheels of global trade and investment. That's the liquidity part. The only way to get more dollars out there was for the US to run deficits, sending more dollars out than it took in.
Okay, sounds simple.
But if the US ran those deficits for too long, the number of dollars held by other countries would eventually swamp the US gold reserves. Once that happened, people would lose faith in the promise that the US could actually convert all those dollars back to gold at $35 an ounce. That's the confidence problem. You'd get a run on Fort Knox.
So, a catch-22. The deficits needed to keep the system working would eventually destroy the trust holding it together.
Precisely. The world was trapped.
And then U.S. policy in the late 60s really poured fuel on the fire.
Oh, absolutely. President Johnson's administration decided to pay for two massive things: the escalating Vietnam War and the ambitious Great Society programs at home, not by raising taxes, which is politically hard,
Right.
but by running big budget deficits and basically printing money, expanding the money supply.
And the result?
Inflation took off in the US, and a flood of these excess dollars washed over the global economy. The US balance of payments deficit exploded.
Which put pressure on other countries.
Immense pressure. Countries with strong economies, like West Germany, suddenly found themselves having to buy up mountains of these inflationary dollars just to stop their own currencies from rising and breaking the peg.
So they were basically importing America's inflation.
Exactly. And they weren't happy about it. Politically, there was a lot of resentment. President de Gaulle in France was famously critical, slamming this exorbitant privilege that let the U.S. pay its bills with money others had to accept.
And France started cashing in its dollars for gold.
They did, aggressively. It was a direct challenge to the whole system's foundation.
So by the early 70s, it's crunch time. Foreign countries are holding way more dollars than the U.S. has gold. The gold stock is shrinking.
The promise of convertibility was basically a bluff by then. The system was living on borrowed time, just waiting for the trigger.
And the trigger came in August 71. Britain, France, others signal they want to convert big chunks of dollars to gold. The run starts.
The moment of truth.
And Nixon's administration doesn't wait. They act fast and alone. August 15th, 1971, Nixon goes on TV, announces the U.S. is immediately suspending the dollar's convertibility into gold. No more gold window.
The Nixon shock pulled the plug without even telling their partners first.
Total turmoil in the financial world. They tried to patch things up briefly.
Yeah, the Smithsonian Agreement.
Yeah.
A last-ditch effort at new fixed rates didn't stick.
Nope. By March 1973, the major currencies were just floating, their value set by the market. The fixed rate era was officially dead.
And this wasn't just politics, it was economics hitting reality. It proved this fundamental idea called the impossible trinity, or the policy trilemma. The impossible trinity. Basically, a country can't have all three of these things at the same time. A fixed exchange rate, capital flowing freely across its borders, and control over its own monetary policy, like setting interest rates. You have to choose 2 out of 3. Bretton Woods was built. Assuming capital couldn't flow freely, there were strict controls. But as global finance, especially those offshore euro-dollar markets, started growing in the 60s.
The controls weakened.
Right. And the trilemma bit hard. Countries had to choose. The U.S. chose keeping control of its monetary policy over the gold peg. Germany chose letting its currency float to get monetary control back. The collapse was almost inevitable once money started moving freely again.
And the end of fixed rates had bigger consequences.
Huge ones. It basically opened the floodgates for the massive growth in global finance and debt we've seen since. Under Bretton Woods, the peg acted like a brake. Floating rates removed that brake. It created an environment where, as someone put it, the rule became, borrow as much as you can, the market will sort out the exchange rate.
Which led to
financialization. Private debt started growing way faster than the real economy. And that paved the way for the super-leveraged, crisis-prone global financial system we have today.
So the old system collapses. The IMF, designed for fixed rates, has an identity crisis. Central banks, cut loose from the dollar anchor, are kind of adrift in this new world of floating rates and powerful global money flows.
A period of major reinvention was needed for both.
How did the IMF adapt? Its main job was gone.
It pivoted. It went from being the umpire for the whole system to being more like a crisis manager for individual countries, especially developing nations that couldn't easily borrow from private markets anymore.
And the first big test was the Latin American debt crisis in the 80s.
That was huge. August 82, Mexico shocks everyone by saying it can't pay its debts. The panic spread like wildfire, threatening huge international banks.
What caused that crisis?
A couple of things. The oil shocks of the 70s meant oil-producing countries were swimming in cash petrodollars, which Western banks then lent out, maybe too eagerly, to developing countries. Then came the Volcker shock.
Fed Chair Paul Volcker raising interest rates in the U.S.
Sharply, to kill inflation. But most Latin American debt was in dollars and had variable rates. So suddenly, their payments just skyrocketed. Default loomed.
And the IMF steps in.
Yes, working with the U.S. Treasury, the Fed, other creditors, the IMF became the coordinator, putting together these complex bailout packages, new IMF loans, rescheduled debt, forcing private banks to lend more too.
But there were strings attached.
Big strings. This is where conditionality really took off. In exchange for the bailout cash, the IMF demanded countries make deep, often painful economic reforms. This policy wasn't totally new, but it got expanded into this comprehensive, intrusive program of economic reengineering.
So these reform packages, the structural adjustment programs, or SAPs, they weren't just about balancing the book.
Oh, far from it. Guided by this idea called the Washington Consensus, they often required changing fundamental national laws, the structure of the state itself. Privatizing state companies, deregulating industries, opening up trade, reforming taxes and banks.
These were legally binding conditions.
Yes, structural benchmarks. You didn't get the next loan payment unless you hit these targets. The IMF's reach became so broad, it even started attaching conditions related to governance, things like military spending, corruption.
Which raises a huge question, right, about national sovereignty.
Yeah.
What happens when an outside body dictates the fine print of your laws and policies, especially when you're in a crisis and desperate?
Exactly, a very contentious point.
And for people on the ground in those countries, the impact of these SAPs.
Often devastating. Austerity was almost always central. To cut budget deficits, governments had to slash public spending. Essential services like health and education, often already weak, just collapsed in many places in Africa and Latin America.
Plus things like subsidy cuts.
Right. Cutting subsidies on basics like food and fuel, cutting public sector wages.
Yeah.
These hit the poorest hardest. Poverty and inequality often surge.
Leading to huge debate.
Fierce debate. Critics slammed the IMF for imposing this rigid, one-size-fits-all neoliberal model, ignoring local realities, undermining democracy, and basically prioritizing Western banks getting repaid. The IMF and its defenders argued, look, this is tough medicine, but it's necessary to cure deep economic problems and ensure countries could eventually stand on their own feet.
Okay, so while the IMF is reshaping developing economies, what's happening with central banks in the rich countries?
A different kind of revolution. Their big challenge after Bretton Woods was the great inflation of the 1970s, high inflation, sluggish growth, stagflation.
And the thinking was politicians were to blame.
That was the consensus that emerged. Inflation got out of hand because central banks weren't independent enough. Politicians kept pressuring them to goose the economy with easy money, especially before elections, even if it caused inflation later.
So the solution was independence.
Exactly. Give central banks legal independence to shield them from short-term political meddling. Starting in the 80s, you see this wave of reforms enshrining instrument independence, meaning politicians still set the broad goals, the mandate, like targeting 2% inflation.
Yeah.
But the central bank gets the sole power to decide how to achieve that goal, mainly by setting short-term interest rates without political interference.
Examples.
Well, in the U.S., the Fed's dual mandate for price stability and maximum employment was formalized, and its structure, with long 14-year terms for governors, protects its independence. In Europe, Germany's Bundesbank was famously independent, and that became the model for the European Central Bank, whose independence is written into the Maastricht Treaty.
And this shift had a real impact on ordinary people.
Absolutely. These independent technocratic bodies now had enormous direct power over your cost of living, your job prospects. When the central bank raises rates to fight inflation, your mortgage goes up, car loans cost more, credit cards get pricier. When they cut rates, borrowing gets cheaper, hopefully stimulating the economy. Their decisions hit everyone's wallet. So if you pull back, this post-Bretton Woods era creates this stark division, this great divergence in how economies were governed. In the rich countries, the global north, central banks get more independence, shielded from domestic politics. But at the exact same time, countries in the global south are losing economic sovereignty, with the IMF dictating policy down to the smallest detail through conditionality.
Autonomy for the rich, subservience for the poor.
Pretty much. And that helps explain why there's still so much distrust of the IMF and World Bank in many developing countries. Conditionality wasn't just economic policy. It became this powerful political tool, using a crisis, a moment of peak vulnerability, to push through a whole economic and legal package, the Washington Consensus that might never have passed democratically in normal times.
Okay, so central banks get independent, the IMF becomes a firefighter. Then the 21st century hits, and boom, shocks on a scale not seen since, well, the Depression and World War II.
The 2008 global financial crisis and then the 2020 COVID pandemic. These weren't just downturns. They were systemic crises threatening global collapse.
And they forced these institutions to just rip up the old rule book.
Completely. They had to abandon decades of thinking, invent radical new, unconventional tools, and coordinate like crazy, almost like Bretton Woods all over again.
Let's take 2008 first. It started with U.S. subprime mortgages.
Yeah, a seemingly small corner of the market. But a housing bubble burst. Defaults surged. Those dodgy loans had been sliced, diced, packaged into complex securities, and sold everywhere globally.
And the trigger for full panic was Lehman Brothers collapsing.
September 2008. The U.S. government lets Lehman fail, and suddenly nobody trusts anybody. Credit markets freeze solid. The whole interconnected global banking system teeters on the brink.
What could central banks even do? Their usual tool, cutting interest rates, was already maxed out. Rates were near zero.
They had to get creative, fast. They rolled out a whole arsenal of unconventional policies on a huge scale.
Like what?
Zero interest rate policy, or a ZIRP, keeping rates effectively at zero for years. Quantitative easing, QE central banks like the Fed, the ECB, Bank of England, just created trillions of dollars, euros, pounds out of thin air to buy up government bonds and other assets from banks.
To pump money directly into the system.
Right. Push down long-term rates, get banks lending again. Plus, they opened tons of emergency lending facilities, basically becoming the lender of only resort, not just for banks, but for other critical financial players to stop catastrophic failures. It was the biggest coordinated liquidity injection ever.
And the IMF's role in 2008.
It came roaring back to relevance after years of people questioning if it was needed. G20 leaders agreed to triple its lending power to almost $1 trillion, making it a credible global financial backstop.
So it provided bailouts.
Massive ones, to countries like Iceland, Greece, Ireland, Portugal, who were locked out of borrowing privately. In Europe, controversially, it teamed up with the European Commission and the ECB, the Troika, to manage those really difficult Eurozone bailouts. And afterwards, it helped design new global banking rules with the Financial Stability Board to try and prevent a repeat. The sheer scale and speed of the 2008 response, it was staggering.
A total rewrite of the crisis playbook.
Absolutely. And it cemented this idea of the central bank as the ultimate rescuer, willing to do literally whatever it takes to stop the system collapsing. But that also created expectations, powerful expectations for the next crisis.
Which came just over a decade later with COVID-19, a very different kind of shock.
Totally different. Not financial initially. It was this external health shock that just slammed the brakes on both supply and demand everywhere, all at once. Instant economic shutdown.
And the policy response, even bigger and faster than '08.
Even bigger. Even faster. Central banks didn't hesitate. They dusted off the 2008 unconventional toolkit and went nuclear. Rates back to zero, QE massively expanded, liquidity hoses wide open to keep credit flowing.
And something new happened too, with emerging markets.
That was significant. Many emerging market central banks, which historically couldn't risk QE because it might cause capital flight, actually started their own asset purchase programs for the first time, a sign they'd matured institutionally.
What about the IMF during COVID?
Equally dramatic response. Focus on speed. Emergency cash to over 60 countries in the first 3 months. They used a special trust fund, the CCRT, to give immediate debt payment relief to the 29 poorest countries so they could spend on health instead.
And the big SDR allocation.
That was huge. August 2021, the IMF approved a $650 billion allocation of special drawing rights, its own reserve asset, the largest ever. The idea was to boost every member country's foreign reserves without adding to their debt load, a shot in the arm for everyone. Now, while all this intervention definitely stopped a worse collapse, it wasn't without problems or critics.
Like what?
Well, some argue the stimulus, especially in rich countries, was maybe too much, and that central banks were too slow to hit the brakes when inflation took off in 2021, partly due to supply chain chaos and all that stimulus money chasing fewer goods.
Leading to the aggressive rate hikes we've seen recently.
It's exactly. The fastest hikes in decades, which then created new risks for financial stability, exposed weaknesses in some banks. And all that crisis spending, public and private, led to a huge surge in global debt. Especially dangerous for developing countries, many now facing serious debt problems again.
And did the IMF really build back better, as they talked about?
Critics would say no. Despite the rhetoric, once the immediate COVID emergency passed, IMF loan programs often reverted to demanding austerity and spending cuts. The old patterns reemerged.
There's also this question about QE blurring the lines between central banks and governments.
A really important one. When central banks buy up massive amounts of their own government's debt, does it create fiscal dominance? Is the central bank's main job controlling inflation, taking a backseat to helping the government finance itself cheaply? That's exactly the problem independence was supposed to solve.
And the constant bailouts, does that create moral hazard?
That's the big fear. This implicit guarantee that the Fed, the IMF, someone, will always step in to prevent huge losses. It might encourage banks and investors to take bigger risks than they otherwise would because they expect a safety net. You stop the short-term fire, but maybe you're setting up conditions for a bigger blaze down the road.
Okay, so navigating the fallout from two massive crises, and now a whole new set of disruptive forces are hitting them. Digital currencies, climate change, geopolitics.
Yeah, it's like a perfect storm. The digital revolution is challenging the government's monopoly on money itself. Climate change is forcing this huge debate about what central banks should even do. And the shifting global power balance, this fragmenting world order, is putting pressure on the whole US dollar system.
That core tension you mentioned earlier between national interests and global cooperation.
It feels more intense than ever.
Let's start with digital. Cryptocurrencies, stablecoins, these are direct challenges.
Absolutely. To the idea of sovereign money, issued and controlled by the state. And the response from central banks has been pretty urgent. Exploring their own digital currencies, CBDCs.
Central bank digital currency, what exactly is that?
Think of it as a digital version of cash, issued by the central bank, a direct liability of the central bank, and potentially available to all of us, the general public.
And this is happening everywhere.
Pretty much. As of mid-2024, something like 137 countries or currency unions, that's 98% of the global economy, are looking into CBDCs. A few smaller countries like the Bahamas, Jamaica, Nigeria have already launched them.
What about the big players?
China's way ahead with its digital yuan pilot, the ECNY. They've processed huge amounts. India's e-rupee pilot is also massive. The European Central Bank is in a preparation phase for a digital euro. Bank of England's looking at a digital pound.
And the US?
The US is lagging behind the other big economies, actually. There's significant political opposition to a retail CBDC, one for the public, so work on that has stalled. Though they are still researching wholesale uses between banks. And motivations vary, right?
Seems so. Emerging economies often see it as a way to make payments cheaper, easier, maybe bring more people into the financial system.
While for the big powers,
more strategic, providing a safe, state-backed alternative to private digital money, defending monetary sovereignty. And there's definitely geopolitics. China and the ECB see their digital currencies partly as ways to boost the international role of the yuan and euro, maybe chip away at the dollar's dominance in global payments.
And the IMF is positioning itself in the middle of all this.
Trying to be the coordinator, offering technical help, developing standards, publishing guides.
So CBDCs aren't just a tech upgrade. It feels more fundamental.
It seems like a political project almost. Reasserting state control over money, bringing the payment system and all the data it generates directly under the central bank. Kind of reversing decades of privatization and globalization in money.
Which raises that crucial question again. What does this mean for our privacy? For the power balance between us as citizens and the state in this new digital money era?
A big question. And then there's the even more contentious debate. Should central banks be fighting climate change?
Hugely divisive.
The argument for is
That climate change is a direct threat to the things central banks already care about: price stability and financial stability.
how so?
Through physical risks, storms, floods, wildfires destroying assets, disrupting the economy, causing insurance losses, and transition risks, the financial losses that happen as we shift away from fossil fuels. Think coal mines becoming worthless assets. Since these risks hit stability, proponents say central banks have a duty, even under current rules, to factor them in. Maybe do climate stress tests on banks, favor green bonds.
But the opposition is strong.
Very strong. They call it dangerous mission creep, way beyond central banks' legal mandates and expertise. They worry that using monetary policy for green goals means the central bank starts picking winners and losers in the economy, allocating credit, which should be politicians' job, not unelected technocrats.
And doing that would undermine their independence.
That's the fear. It would kill the political neutrality that makes them credible.
Yeah.
And legally, most central banks can't just decide to do this. A study found only about 12% globally have explicit sustainability goals in their legal mandates.
So you see a split.
A clear global divide. Europe, China, they're pushing ahead more. The U.S. Fed, much more cautious, reflecting the deep political battles over climate policy in the States.
And all this is happening while the whole world order is shifting. The post-Cold War, U.S.-dominated era is over.
It seems that way, moving towards a more multipolar, fragmented world.
Yeah.
And that creates huge challenges for the IMF and the dollar system.
How does China's rise affect the IMF?
Well, China is now a massive global lender itself. It offers developing countries an alternative source of cash, often without all the IMF's strict policy conditions. That definitely reduces the IMF's leverage, its influence.
And the weaponization of finance, using sanctions.
That's been a game changer, especially the G7 freezing Russia's central bank reserves after the Ukraine invasion. That sent shockwaves everywhere.
Making other countries nervous about holding dollars.
Exactly. It made holding reserves in US dollars look potentially risky. So countries are actively looking for ways to de-dollarize, to become less vulnerable to US financial power and sanctions.
And new financial plumbing could help that.
Potentially. Things like Project Ambridge, this wholesale CBDC platform linking China, Thailand, the UAE, Hong Kong, Saudi Arabia. It creates payment channels completely outside the traditional US-controlled SWIFT system. So you put all these things together, the debt, the geopolitics, climate, digital disruption. Some people call it a polycrisis.
Multiple crises hitting at once.
And this environment puts that hard-won central bank independence under serious threat. Every new challenge creates pressure for them to step outside their core job of fighting inflation. Climate change pushes them toward industrial policy. High government debt pushes them to keep rates low to help governments borrow cheaply. Geopolitics forces them to act like foreign policy tools.
Each step erodes their neutrality.
Drags them deeper into politics.
Wow.
So the big question becomes, will this model of the independent, technocratic central bank, the big achievement of the late 20th century, actually survive the pressures of the 21st?
Or do we go back to an older model?
Possibly. Back to where central banks are more obviously instruments of state power, like they were way back at the beginning of the 17th century. That fundamental tension, national versus international, state needs versus monetary discipline, it's incredibly acute right now. How they handle this era of big power rivalry and systemic shocks. It's going to shape global economic stability for years to come.
Wow. Okay. That was quite a journey. Centuries of economic history, from Swedish copper scandals to digital dollars and climate fights today.
Yeah, a long and often bumpy road.
And we've seen how these institutions, the central banks and the IMF, they've constantly had to change, often born out of crisis, always doing this balancing act
between wanting trustworthy money and dealing with the realities of politics and power.
It really does come back to that continuous dialogue, doesn't it? National sovereignty versus global cooperation, public good versus private profit, and that core tension, guardian of value or government financier.
Which leaves a really important question for you, the listener, to think about. In this world we're in now, with global challenges but also fragmenting power, what kind of monetary guardians do we actually need? Will we see, or should we want, a more independent, technocratic approach to fix these huge, complex problems? Or will the pressures of this polycrisis just inevitably pull these powerful institutions back into serving national political goals more directly?
Yeah.
And, how might that shift impact your own economic life and the stability of the whole system?
Something to definitely think about. This has been the deep dive into the guardians of value.